lead to a high financial leverage. A company cannot, but what happens when a company takes up too much debt on its books? When a company is taking high debt, it will of course not sustain its margin and asset turnovers for long period. And however, for a short period, a company can deliver extremely high ROE. As for the short period, the equity requirements of the company go down due to the presence of huge debt. But in such a case, it is much better to use ROIC, which is return on invested capital, because in case of ROIC, you basically negate the effect of leverage. So what is ROIC? ROIC is net operating profit after tax. And the denominator over here is total invested capital. So what is total invested capital? In total invested capital, you take both equity and debt. So as I gave the earlier example where I started my business with 1 lakh rupees. Okay. And at the end of the year, I made 10,000 rupees. So my return on equity was 10%, right? Now, in the same example, just imagine you had, so I had 50,000 of debt and 50,000 of my own capital. So I took loan from my friend and I used 50,000 of my money. So basically I invested 1 lakh rupees, but 50,000 of my equity was there. So in that, if you calculate the ROE, the ROE would be 10,000 by 50,000, which will come to 20%. So it will look like my business is doing much better, right? So I should be putting in more debt in my company, but that is not sustainable, right? Because when I'll put more debt, I'll have to service that debt, and eventually it will put more pressure on the earnings. So my friend gave me 50,000. Maybe he's not asking for any interest in the first year or any return of money in the first year, but second year onwards, third year onwards, he will be needing it back with some returns, right? So that is how, if you have to calculate my performance, then it should be ROIC. So net operating profit after tax divided by total invested capital. So 10,000 is the profit, and 50,000 plus 50,000 debt plus equity becomes 1 lakh rupees. So the ROE comes to the ROIC comes to 10%. So over here, ROE is misleading, but ROIC is the true figure. And the second point was excess cash on balance sheet, right? Again, we'll just use a very simple example. This is a very simple balance sheet. You can see 100 crore liabilities, 100 crore assets. So 40 crore is fixed asset, 60 crore is current asset, and equity is 40 and other liabilities also 60. And PAT for the year is given as 10 crore. So the prima facie ROE is PAT by equity, that is 25%, right? But if we are to told you that in the current asset, it is found that cash in hand includes 10 crore of excess cash. What do I mean by 10 crore of excess cash? This is the cash which is not required in the business. This cash is not required for the daily operation of business. This is extra cash which has been earned due to several years of profitable business. So what actually we need to do in that case? We should actually remove this 10 crore from the asset side, and similarly, you should also reduce your equity by that same amount. So what you see over here is your balance sheet size. So just remember the example of Nestle. What it did, it basically gave back this excess cash to the shareholders in the form of dividend. Over here, we are not giving it as a dividend, but we need to understand that we should try to understand that, okay, this 10 crore is something which is not required in business. So let us take it out of the business for our calculation, and let's see how the operating business perform. So for that, we need to take this out, and our calculation then comes as our equity reduces by 10 crore. So it becomes 30, and we since this cash was not needed in the business, our PAT remains the same. So when you divide 10 by 30, of course, the ROE, which was earlier 25%, now becomes 33%. Right? I'll just pause for 10 seconds so that you can look at the balance sheet. Again, it was earlier 100 crore balance sheet, right? 100 crore asset, 100 crores liabilities, and 10 crore of excess cash. So what we did, we just removed that 10 crore excess, right? And just